How we doing? Today is Thursday, August the 1st, 2024. Um, we're just continuing our series on seller financing and real estate notes. We're still focusing primarily on seller financing today. This is session number 4. If you want to see the other 3, you can go to my YouTube channel, Abundant Capital Group. You'll see the first 3 sessions there under the playlist, seller financing and real estate notes. So today, not going to be too long, but I just wanted to kind of share this article here and kind of go through it a little bit and talk about it when it comes to the tax benefits of selling with an installment sale or with seller financing. So I'm just going to read through it and then make some comments and kind of go through it, and it'll show you some math and things like that. So if you're someone that has a rental property and potentially thinking about selling it, and obviously you're concerned about the tax hit that you're going to take, this will definitely help you. If this is your primary residence and you're going to sell, and obviously you're going to make some money from the sale, this the capital gains tax doesn't affect a single or married couple up to a certain amount. And for a single person, it's up to $250,000 of capital gains, and for a married couple, $500,000. So until you get over those amounts, then you would potentially want to think about doing an installment sale if you're concerned about capital gains tax. So I'm not giving tax advice or legal advice. I just want to make that clear. I would definitely take the information that we're going to go over and speak to your financial advisor, person that prepares your taxes, and talk to them about it. But this just wanted to kind of, get you to thinking, think about your circumstance. Is capital gains something that you're concerned with, if you're going to sell, or, may have to sell relatively soon? You might want to think about using this. So the article reads here, most property sellers think about selling real estate like this: list the property, sell the property, receive cash. There are times when receiving a lump sum of cash is beneficial. For instance, when the seller will be purchasing another um, personal residence, paying off debts, or want to take a trip around the world. So again, right here, just starting out, basically, with a basic foundation is that, if you're somebody that is selling a property and you have that money earmarked for a specific reason where you need all of the cash, you need all 100,000, 125,000, $200,000 worth of equity, you need it to go towards making another investment. As it says here, take a trip around the world, maybe pay for a wedding, whatever it is, take that vacation that you always wanted, whatever it is, and you definitely need all of it to go to that. Then selling with an installment sale or seller financing is probably not the best option for you. But there are a lot of people who have lived in a property or purchased a property, gained some equity, and they don't necessarily have the money that they're going to receive going into something right away. They may be selling it for other reasons. It's at the height of the market. You think it's going to change. You want to make sure that you get all your equity, or something like that. Or you only need a portion of that $100,000, $200,000 to then go and do what it is that you need to do, whatever, if it's an investment, or you just want the money to buy a new car, or whatever the case may be. But you don't need all of the cash to do that. You would want to consider this, and it'll kind of get into more reasons why. However, in some instances, receiving a lump sum of cash isn't beneficial, as I was just saying. The seller could be responsible for significant capital gains tax. Cash sitting idle in today's low interest environment earns next to nothing. So most bank accounts and most accounts that you would put the money in, only going to get you 2, 3, 4, maybe 5% if you put it in treasuries right now. But that could change. It looks like the treasury yields are actually, coming down. So are you just going to take the money and stick it in some low interest bearing account? or there's always the temptation to spend the money as it burns a hole in one's bank account. So, as a note professional and real estate investor, it is essential to understand the above issues and understand how installment sales can be a solution. What is installment sale? So if you want to, look further into this, if you're the type of person that wants to research it, you can look up IRS publication 537. You can look that up in the tax code and read the whole thing. But basically, it says a sale of a property where you receive at least one payment after the tax year of the sale. So if let's say you're going to sell today, but you're going to receive payment in 2025 and beyond, that's going to be considered an installment sale. When a seller agrees to buy, when a seller agrees with a buyer to accept payments over time and the term extends into the next year, that's an installment sale. Most of us also recognize this as a form of seller financing, and that's what we're focusing on. Real estate installment sale example. So here's going to get into the numbers and how it breaks down and the benefits of it. So hopefully, it makes sense. If anybody sees this and wants the article, because they, more visual type of person and wants to see it for themselves, I can send it to them. If you just leave me a comment or a message, we'll get it out to you. Steve is going to be selling a house that he has been renting out for $500,000. He purchased the house many years earlier for $250,000. While owning the home, he invested another $50,000 in upgrading the kitchen and bathrooms. So that's a typical example of somebody who invested. Somebody maybe in their mid to late 30s, purchased a property, knew about real estate, and started receiving income from this property. And then now, maybe 10, 15, 20 years later, they want to sell it. So his adjusted basis in this example, that's total capital invested is 300,000 because they purchased it for 250,000 plus put another 50,000 in it. His capital gain on the appreciation is 200,000 because he's going to sell it for 500,000. So that is how they're calculating that particular gain of $200,000. 250,000 plus the 50. I think I said 200 before, but it's $250,000 to purchase it plus 50,000. It's 300,000, and then he's selling it for 500,000. So they're technically the adjusted, what they call the capital gains on this is $200,000. Guess who wants to tax Steve on that juicy $200,000 capital gain? That's right, the IRS. Depending on which state he lives in, his tax authority may want a piece of it too. So you may have to pay not only the federal tax, but maybe some state tax as well, just depending on the state. So again, this is why you want to talk to, the person that, handles your financial business, prepares your taxes, things of that nature, and, just find out what's going on in your state. Making matters worse, an extra $200,000 in or to his existing income in a single year could push them into a different tax bracket. Again, another reason why you want to, speak to your tax person in regards to this. But Steve is smart. He realizes a few things. He doesn't have an immediate need for the sales proceeds, which we discussed. He's gotten used to the monthly income from his rental property, because when you sell it now, you take all of that money, you don't get that monthly check. And this is ran as an installment sale, or selling with seller financing is another benefit to you. He could sell the house on an installment sale, and by doing so, he will defer receiving the capital gains portion of the sale over many years. He will receive interest on the unpaid balance, and he will receive monthly payments. So you're going to receive a certain portion now. The remaining that's owed to you can be interest bearing. What that is, that could be up to you. We could figure out, what type of payment that you'd like to receive every month. Maybe you were getting, $500 a month, and there's a way that we could figure out to give you $750 a month, and that would equate to a certain amount of interest on that remaining balance that's owed to the seller, and you'll still receive those monthly payments. So you're actually getting more cash flow on a monthly basis than you were, as a rental property. So as I said, it says here in the article, because Steve is really smart, he speaks to his tax professional when first considering and before implementing this, and you should too. He also familiarizes himself with creating notes and relies on other experienced team members to fill in the gaps. The IRS reporting formula factors selling expenses and existing debt into the selling cost, as well as the depreciation recapture into adjusted basis. While many sales will include these items, this article chooses a streamlined scenario. How does deferring capital gains work? Receiving payments and interest over time are simple concepts, but deferring capital gains deserves an additional explanation. So this is kind of getting into, the real nuts and bolts of why you would want to consider this. When Steve sells his property, 40% of the selling price will be the gain. The 40% is the $200,000. That's what his gain is. The IRS calls this gross profit percentage. It's the $200,000 divided by the 500 that he's selling for, and you get 40%. If he sells the property and receives a $50,000 down payment at the time of the sale, 40% of the down payment is reported as capital gains, and the remaining portion is reported as a return of capital. So the capital gains, you only get taxed on the 40% of the 50,000 now, which is 20,000. 30,000, the balance of that from what you got on your down payment is non-taxable. And that's where you get the total of 50,000. The principal portion of each subsequent payment will be allocated the same as the down payment, 40% capital gains and 60% return of capital. Therefore, if Steve receives 5 loan payments of $1,000 in a year, in year one, the taxable portion of those payments will not be 5,000. They'll be 40% of that. So let's just say we're taking the full year, because they only, in this example here in the article, they only took 5 payments. So let's just say it's 12. What's 40%? 12,000. What's 40% of 12,000? So you're only going to pay $4,800 on that. And then the remaining balance of that, what is that, like $7,200? That's considered non-taxable. And so you can do that each and every year to be able to save on those taxes. And with that 40% that you're getting taxed on, there's certain things that once you discuss with your tax professional, there's things that you possibly could do to even reduce that a little bit more. But that would be something that you would have to discuss with the tax person. The total amount of taxable gains he will receive in tax year one will be $2,500. He has deferred the remaining $175,000 in capital gains until subsequent years. Thus, Steve will only pay capital gains taxes in the following years on the amount of the capital gain he received each year. So he's not going to pay it on the whole $175,000. You're only going to pay taxes on the portion that you receive for that particular year. And in this example, if they're receiving $1,000 each month, it's only going to be taxed on $12,000 instead of the $175,000. So it says here, can interest be deferred? Unfortunately, the short and long answer are both no. Interest is taxable as ordinary income in the year it's received, even if your agreement with the borrower is 0% interest and calls for a non-interest period. IRS and unstated interest or original issue discount OID apply. So I don't want to get too far into that. That's getting probably a little bit too technical. That's something, again, that a professional tax person or somebody that handles your financial business, you can discuss that with. But the main thing that we want to talk about is how we can break up that total gain. And in the example that we gave with the $50,000, we just got $30,000 that wasn't taxed, because we're selling a property this particular way. And that is really, what I want people to understand, and how you can defer this each and every year, going forward. And this here is going to talk about selling a primary residence. If you're selling a primary residence and your capital gain, if single, is $250,000 or less, or $500,000 or less for a married couple, you're exempt from capital gains tax. So, if you happen to fall in this, if you have a property and you may have bought it free or clear, and now it's worth $400,000 or $500,000, and you're a single person, you may want to consider using this strategy, because you're going to get taxed on anything above that $250,000. If you're a married couple, you lived in a house a certain amount of time, and now you've got over $500,000 worth of equity. You want to consider selling with an installment sale. And so the last part of this says, does a real estate installment sale have disadvantages or limitations? No scenario is perfect. And again, your unique scenario is something that you should discuss in advance with a licensed and qualified professional. That being said, there's a risk of non-payment if the borrower falls behind or defaults. Not only will it impact impact your cash flow, it can also lead to an expensive and drawn out legal process, taking back the property, et cetera, et cetera. To minimize risk, you can use a third-party underwriter, one that's called Call the Underwriter, who will verify your borrower's ability to pay. So, and a lot of times, just depending on where you are in the state that you're in, you can write in certain clauses too when you create your note for doing a seller carryback, that you can have language in it. If this person gets behind so many months, there can, in some cases, you can have them pre-sign the deed, and the property can be signed over to you after, maybe missing 3 consecutive months or something like that. But again, these are all things that you have to find out from your state, from an attorney, what can be put into these documents to kind of protect you in the case that something goes wrong. Because in any investment, something can go wrong. And in this particular article, you could be somebody that's had tenants. And I'm sure over the course of, if you've been a landlord for a certain amount of years, you've had certain things go wrong as a landlord. So things can definitely can go wrong, but we can minimize those by writing these things correctly, making sure that we have someone that's in the property, and especially somebody that that wants to put $50,000 down. The chances are of you having to go out through a long, drawn out foreclosure process and things like that. We can kind of minimize those things because of who we put into the property. Taxes and insurance. Unpaid property taxes and insurance premiums carry a high risk of loss for the lender. Engage in a reliable loan officer to monitor both. A loan servicer to monitor both. Even better, allow your servicer to impound taxes and insurance funds to an escrow account each month. So again, if these things are written correctly, which we can help people do, you make sure that you want to get these amounts escrowed. And that's becoming a big thing, even going, in the market that we're in now. If you look at places like Florida and Texas, a lot of times you're seeing a significant increase in taxes and insurance from one year to the next. And if you're not, keeping an eye on this, or have a servicer that is keeping you abreast of, what the potential increases are from year to year, so you can, make sure that this person that's living in the property can handle it. These are things that you want to be able to stay on top of, but you can use a third party to do that. Reporting. The reporting is specific, and record keeping is critical. The IRS Form 6252 is used to determine and report installment income. This again could be done by a tax professional. Can make sure that this proper reporting goes on. That's what you're paying them for to do. Dealer sales. The installment method can't be used for real property held for sale to customers in ordinary course of a trade or business. If you're in a situation, you are a real estate professional, house flipper, are an example. The homes they purchase to sell later are considered inventory. So this gets into, when they consider you a dealer type of person. So that's a little bit more complicated. We won't really, kind of get into that. That's something that, again, a tax professional would have to speak to you about. And this is someone whose business more so would be a flipper or something like that. Or if you started to do this, several different properties, you could then potentially become a dealer status. And then, you just have to make sure that you're abiding by everything when you are considered to be a dealer. And you're, like, again, tax professional should be able to explain that to you. Selling at a loss. IRS installment sales are only permitted when there is a gain on the sale, not a loss. You are not precluded from using seller financing. However, you will not be able to defer a loss for tax purposes. So you have to be making a gain on this. Can't be, trying to do this and then writing it off as a loss so you can, obviously get another tax advantage. That is something that you can't do. And sale to a related person. So it has to be, special rules apply. You have to see the IRS publication 537, sale and later disposition. So those are some of the down parts, or some of the things that you have to, kind of take into consideration. But again, all of these things can be handled by a third party person. Can make sure that, once you speak to them, let them explain to you your situation and, what you're trying to do. And they can tell you if this, and, if this is something that you should do, that's going to help you on your overall taxes. So I don't see any real big disadvantages here. So it says final thoughts. As a note professional and real estate investor, it is important to understand tax deferment strategies such as real estate installment sales or 1031 exchanges. The reason is that it's our job to listen to people and help them with their problems. Imagine bidding on a property and the seller agrees to seller finance because you discover he or she was concerned about capital gains tax. As a result, you introduced her to the concept of installment sales and won the deal on terms over other investors. You listened and then reached into your knowledge toolbox to suggest a solution. Finally, knowledgeable investors know the value of controlling when and sometimes if they pay income taxes. Methods such as deference require planning, but can reap huge rewards. And this is the person here, Marco Barrero. I'm actually in a real estate group with him, and he wrote this particular article, and that's, his contact information if you do want to reach out to him. But like I said, the main part of this was just to show you, what type of savings, what type of money that you can put into your pocket without being taxed. And, obviously, if you're in more expensive markets and you have a realized gain of $200,000-$300,000, being able to have 60% of that not be taxed is pretty huge. So that's really the point. I wanted to show kind of the math of it and how it all comes together on, your cost basis and maybe some repairs that you put into it, and then the selling price, and then how all the numbers kind of come together. But essentially saving on about 60% of any type of realized gain from year to year, I mean, that money adds up significantly. And if you took all of this money in a lump sum one time, it could push you into a different tax bracket. Who knows what types of taxes you would have to pay then, and how sophisticated your tax preparer would have to be to get you some write-offs and things like that. But if you can spread this out, and then with the money that, is a realized gain, if you have certain things that you can write off against it, that would be a tremendous help for you. So again, this is for primarily, some investors or people who may own 1, 2, 3 properties, something like that, considering selling it, knowing that, they built up a lot of equity, especially over these last 3-4 years. We've seen equity skyrocket, a lot of markets double digits, in multiple years, which is, something that typically doesn't happen. So you could have purchased a property, 3 or 4 years ago, and it'd be worth, 50, $60,000 more now. And you may be consider selling it. You may want to consider selling it this way. If you are, we're someone that can help you structure these things properly. We look to purchase when anyone is offering seller financing, because what we try to do is then, buy a property with seller financing and then try to help a buyer become a homeowner by offering seller financing. And the difference that we can make between what the seller of the property gives us and what we're going to charge the buyer works out great for us. If you don't want to do it that way, we can just, try to bring you a buyer for the terms of what you're creating. We could do that as well. So just something that I really think that people should think about. Like I said, in the times that we're going through right now, the market is shifting. You're starting to see, price drops, things of that nature. Properties stay on the market a little bit longer. A lot of as of today, August 1st, some of the economic data, didn't come back so great. A lot of, big companies and good companies are not hitting their earnings. So things are slowing down and things are changing. Banks have some issues with the commercial real estate. Them extending loans to people is going to most likely pull back somewhat. And, we don't know how long this time frame is going to be here, but while it is here, if you can understand how to create seller financing for buyers and also buy and sell real estate notes, you'll be able to do well during this particular time. In times like this, when banks and the economy is going through some issues, seller financing and real estate notes do well during those particular times. And, that's really why we're focusing on this. If you heard me before, if this is the first time, I started looking into this back in 2008 and really just didn't take advantage of it at that particular time. And a lot of people did, and a lot of people got wealthy, during the great financial crisis because they did take advantage of seller financing and real estate notes at that particular time. So if you have any questions, you see this on the replay, reach out. Telephone number is 973-475-8488. Or you can send me an email at investorgmr@yahoo.com and send me a text there. I'll send me an email or text that number or call the number that I gave. And, we can answer any question that you might have. If you want this article, I can send you a copy of it and, you can read it for yourself. So a lot of benefits to this, not too many disadvantages, all things that we can manage with third-party people and professionals. So, think about it and see if it's the right thing for you. All right. I'll see everybody back here next week, Tuesday, and we'll continue to talk about, seller financing. We'll go through another topic when it comes to seller financing next week. All right. Have a good one.